Today on our review for the SIE exam, we're diving into real estate investment trusts, commonly known as REITs. At its core, a REIT is a company that owns, operates, or finances income-producing real estate, allowing individual investors to buy shares in commercial real estate portfolios that they otherwise couldn't access. Think of it as a mutual fund for real estate. The single most important concept you must know for the exam is how a REIT avoids being taxed at the corporate level. This is accomplished through what's known as the conduit or pass-through theory. To qualify for this special tax treatment, a REIT must pass along at least 90% of its net investment income to its shareholders in the form of dividends. This is a number you absolutely must memorize. An exam question might present a scenario where a REIT distributes 85% of its income. In that case, the REIT would be taxed like a regular corporation because it failed to meet the 90% threshold. To remember the key qualification rules, use the phrase 75-75-90. This will be your mental shortcut on test day. We already covered the 90% distribution requirement. The other two numbers refer to the asset and income tests. First, at least 75% of a REIT's total assets must be invested in real estate, cash, or U.S. government securities. Second, at least 75% of the REIT's gross income must be derived directly from real estate activities, such as rental income or mortgage interest. The exam could test this by describing a company's balance sheet or income statement and asking if it qualifies as a REIT. If a company generates 50% of its income from a non-real estate business, it fails the 75% income test. Now let's break down the different types of REITs you'll encounter. The most common type is the equity REIT. These companies physically own and manage properties. Think of large apartment complexes, regional shopping malls, or downtown office buildings. Their revenue comes primarily from collecting rent from tenants. A simple way to remember this is that equity REITs have equity in the actual properties. The second type is the mortgage REIT. These don't own any buildings. Instead, they act like banks for real estate. They lend money to real estate developers and property owners, or they invest in mortgage-backed securities. Their income is generated from the interest they earn on these loans. A typical exam question will ask you to identify the type of REIT based on its revenue source. If the revenue is from rent, it's an equity REIT. If it's from interest, it's a mortgage REIT. There are also hybrid REITs, which, as the name suggests, are a combination of both, owning properties and holding mortgages. Finally, let's discuss two critical points from the investor's perspective. The first is liquidity. Because most REITs are exchange-traded, they can be easily bought and sold throughout the day, offering far greater liquidity than owning physical property. The second point is a major trap for exam takers, the taxation of dividends. The income you receive from a REIT is taxed as ordinary income, not as a qualified dividend. This means it's taxed at your personal marginal tax rate, which is typically higher than the preferential rates for qualified dividends. The exam loves to test this distinction. Remember the phrase, REITs give you ordinary returns, not qualified ones. This will help you correctly answer questions comparing the tax treatment of REIT distributions to dividends from a standard corporation.